All right, we're on learning objective 14.3, and we are going to get into making the journal entries for bonds payable and interest expense using straight line amortization. Okay, the other one was that present value tables. We're not going to do that in this class, but we will do that in financial management. All right, so we kind of talked about these three already. A bond can be issued at face. That just means market and stated rate are the same. A discount means the market rate is higher than the stated rate. A premium means the stated rate is higher than the market rate. Okay. So the first one they give us is Smart Touch Learning has $100,000, 9% bonds payable that mature in 5 years. Okay. The companies issued these bonds at face on January 1st, 2025. Remember I told you in the last video, I get a little blurb of information. Um, we have our face as 100K. Our stated rate is 9%. We know that our market rate is 9% because they said it was issued at face. Okay, so we know those are the same. It is a 5-year bond and they pay interest. They did not tell us how often they pay interest. Okay, that's fine. Maybe they'll tell us here in the next one. The next example they do. All right, so all we're going to do here is we are going to debit cash and credit bonds payable for 100,000. Okay, at face, there's no other accounts. We are going to get $100,000, and at the end of 5 years and our interest payments, we're going to pay back $100,000. Okay, so the next thing, here's where they tell us interest payments occur each June 30th and December 31st. That is great because by them doing it like this, paying on December 31st, we don't have to make an adjusting entry to accrue the interest expense. Okay. So there might be a problem that does that, but this is great for us to not muddy up the water too much right now. Okay. So it's a semi-annual interest. We have all our information back up here. So I'm going to pull a calculator up again and let's look at, we're going to look at 100,000, multiply that times 9%. That's 6,000 for a year. They're doing semi-annual, so we're going to divide that by 2 to give us $3,000. Okay, so I didn't do that right, did I? I think I put 6 in, didn't I? Yep. So let's do that again. 9 divided by 2. Okay, gives us 4,500. Okay, so we are going to debit interest expense here, 4,500, and credit cash for 4,500 as well. Okay, every single semi-annual interest payment will look exactly like this for this problem. Okay, if it's issued at face, they'll make the same entry, 12/31 of 25, and every 6 months until the end of that bond. Okay. Now let's do one at a discount. Okay. We have some of the same things from the previous one. Our face is 100,000. Our stated rate is 9%. It's still 5 years. And it is still semi-annual interest. Our market rate is also 9%. I'm sorry, I did not mean to put 9%. Our market rate is 10%. Okay, that's like my computer's running a little bit slow here. All right, yes, my computer was about to die, so I got it plugged up really quick. So let's come down here, and I had wrote down 9%, but the market rate is actually 10%. Okay. Market rate higher than the stated rate. We know it's going to be a discount. Okay. We didn't have to calculate the the discount. They did that for us. They will probably do that for every problem in this chapter. If when you get to financial management and we learn present value tables and stuff like that, you'll be able to calculate these numbers. Okay. So they're only going to get 96,149 because remember we have to discount our bonds because nobody wants our bonds. Our bonds are paying less than everybody else's. Okay. So we're pricing them lower so they will yield 10%. And this is where the students are like, why? Why? Well, remember what I said? These two things are printed on the bond. Okay. We can't change those. They're printed on the bond. So that's why we have to make these adjustments in our accounting records. Okay. And thinking about that, we're also going to calculate the interest payment will be the same. Okay. It won't be the same, it won't be going to the same accounts, but it will be the same cash that gets paid out. Okay. So we will debit cash for this issue price. This is that 96,149. That is our issue price. We're going to credit bonds payable for 100,000 and we will debit discount on bonds payable. So what type of account is that, Miss Solano? Well, let me pull out some T accounts here because you know I love them. Discount on bond payable is a contra liability account. Okay, so these are companion accounts. Our bonds payable has the 100K in it. Our discount on bonds payable has 3851 in it. These two together have a book value right now equal to the issue price. That book value is the 96,149. Okay. What does that 3851 represent? It represents more interest that we have to pay. Okay. More interest that we have to pay at the end. Because at the very end of this bond, we're still going to pay $100,000 back. But we only got 96,149. But that's okay because we're looking at the market rate. Okay. Oh, look, they drew the T accounts out for us. So you can see that carrying value. Okay. How will it be presented on the financial statements? Just like this. Okay. Bonds payable, less discount on bonds payable. Okay. All right. So the discount, I've already said that, is a contra account, is a contra liability. Okay. Note that they borrowed 96,149, but they're still going to pay back $100,000. Okay. I think I've already said everything that's on that slide. Okay. Now we're going to figure out how to amortize this discount over the life of that bond. Remember that little blurb of information? Okay. If you're working a problem, you'd still have that in the margin. What we need here is that 10 semi-annual interest payments. Okay. 10 semi-interest payments, and we're going to we're going to take that 3851 divided by 10 to get 385. And every single payment date, we're going to amortize 385 of that discount on bonds payable. Okay. So remember I said the cash is going to be the same. Okay. This is the same because that's what's printed on the bond. Okay. Printed on the bond. Okay. So what are we doing with this discount? So do they, oh, they have T accounts down there. Yay. Okay. So I drew these T accounts out. We had that January 1st, we had 3851 in there. We are amortizing the 385 over those two interest periods, and that brings that discount down. Okay. Over the next 5 years, they will gradually do that every single interest payment date, okay, until this discount on bonds payable is zero, okay. By the last interest payment date, it's going to keep going and it's going to zero out, okay. Discount on bonds payable is always going towards zero. These two accounts together are always going towards the face. Okay. So you can see how the book value, by them amortizing that extra 385, that's making the book value go up. Okay. The book value of that's going up. It was what, 90, can't remember, 96 149. Okay. Now it's gone up by the amount of those two. Okay. So the discount is going to be always going towards zero. The two accounts together are going to be going towards the face, what is printed on the bond. Okay. So here is an amortization schedule on this bond. The great thing about straight line amortization is that it's going to be the same every time. Okay. We don't typically do straight line, but it is good to kind of introduce this subject. And sometimes businesses will use straight line because there's not going to be a lot of difference between straight line and the actual time value of money tables. Okay. So notice how I said this, that discount that gets amortized, that was going towards zero. Okay. This carrying amount is going towards the face. Okay. That's for a discount or a premium. It's just going to be opposite with a premium, but it's always, always going towards the face. Okay. So now let's look at issuing bonds payable at a premium. Okay. When the stated rate is greater than the market rate, the bonds are sold at a premium. Okay. They have another account with them, but they call this an adjunct account. I don't know why they call it an adjunct. I actually didn't even know that until a few years ago. So I just didn't know what they called it. I knew what premium was. So we have premium on bond payable. So we will have an amount in the credit side of our bonds payable, but we'll also have another amount over in the premium on the bonds payable. Okay. Face will always be, I don't know what went crazy with my screen there. Face will always be in the bonds payable account. So if you can't get anything else right, a lot of times you can get that part of the journal entry correct. Okay. So they're going to give us another example. And I'm just going to underline what are the face. So I see that's my face. So Smart Touch Learning issues 9% 5-year bonds when the market rate is 8%. We're going to assume that the bonds are priced at 104.10. That just means 104% of the face. Okay. They didn't tell us that in the previous one. They just gave us that number, but I just want you to say you take the face multiplied times 1.0410. Okay, it's kind of a understood percent sign right there, and that will help you do that if they give you that number. Okay, so there's 104 100. That is what our issue price is. Okay, how much cash are we going to get? We're going to get 104 100. Okay, that's how much cash we're going to get. That's the issue price. We're going to credit that bonds payable for 100,000. That's the face. And we're also going to credit that premium on bonds payable. They're going to be listed together on the balance sheet. Okay. So now, what does that $4,100 represent? It represents less interest that we are going to have over the life of this bond. Okay. It's going to make our interest expense go down. Because remember, we're pricing it for the market. Everybody else's bond is cheaper than ours right now. Okay. So this is how it is on the balance sheet. We have the bonds payable and the adjunct account that gets added to it for 104 100. Okay. All right, so the beginning premium of 4,100 is going to be divided by the 10 semi-annual interest periods. So every 6 months, we are going to amortize $410 over the life of that bond. Okay. Try to remember, I know this can get really confusing. Try to remember the things that are going to be the same no matter what the bond is. Notice how this cash was the exact same for all three of those. You can get cash right every single time because cash is always going to be the face multiplied times the stated interest, what's printed on the bond, and how often they pay their payments. Okay. So 410, I'm hoping they have the T account right here. So you see we have our bonds payable 100,000 and our premium on bonds payable is getting amortized. Two of those interest payments got amortized over the year, brought that premium on bonds payable down. Remember I said discount is going toward zero, premium is also going toward zero. Okay. And we'll keep on doing that. In the end of that bond's life, this account will have $0 in it and only 100,000 will be paid back. Okay. So after that, you can see how it's going towards the face. Remember I said on the discount, it's going towards the face. It was going up towards the face. Now it's going down towards the face of the bond. Okay. Here's an amortization schedule. We're just going to amortize $410 over each period. Notice here's our carrying value going towards the face. Okay. The premium is going towards zero, same as the discount. Okay. All right. So now we're going to talk about retiring bonds. You're like, oh, Miss Solano, we just talked about having bonds now. We don't want to talk about retiring them. Well, you can pause the video for a few minutes if you need to. Okay. So, how is the retirement of bonds payable accounted for? So, they give us an example here. Smart Touch Learning has 100,000 9% bonds that mature on December 31st, 2029. Note that all interest has already been paid and the discount is fully amortized. If they say those words right there, this is going to be the easiest thing ever. Okay. Because once the discount has been fully amortized, that means there's zero in that account. There's nothing in that account. So you're just going to pay back $100,000. So you're going to debit the bonds payable, credit cash. And it doesn't matter if it is a bond at face, discount, or premium. If they fully amortize all three of them, this is the exact same entry that will be made for every one of them. This entry won't change. Okay. The only time this might change is if they do it before it's fully amortized. Okay. Which can happen. Okay. All right. Some companies retire their bonds prior to maturity. The main reason could be to relieve pressure from paying interest payments. Some bonds actually have a callable feature. Okay. So they may have a feature in there to call a bond. And a lot of times they'll use that call feature if interest rates go up or down. It might benefit them to call the bond in, take a big hit on the value of the bond right then, and then reissue the bond because they could reissue it and get a better interest rate. This would happen where I worked at. The thing is, when you had a bond get called in, then they had to find another investment to put that money into. Okay. So they do have call features on them. Usually, call features are going to have a premium on them because they're trying to be nice and like, hey, we're going to call this in, but so the bond holder is actually going to make some money off of it. Okay. So December 31st, 2025, Smart Touch Learning has a $100,000 bond payable outstanding with a remaining discount of 3081. Okay. And the company can buy the bonds on the open market for 95. Okay. So they have a carrying value of 96.19. But they can go out there and they can buy their bonds back for $9,500. They're going to retire 96,919 of debt with only $95,000. Who wouldn't do that? Okay. They're gonna take that gain and run with it. Okay. So that's a gain. Realize it wasn't the end of the bond when it was completely amortized. Okay. To make this journal entry, we have to get this off the books and we have to get this off the books. Okay. Do they make that journal entry? Yes, they do. Okay. Bonds payable is getting debited for 100,000. They are going to credit the discount on bonds payable. They're trying to get rid of that. Okay. Those two together made up that 96 number. Okay. We have that gain of 1919 and we credit cash for 9,500. All right. All right. Um, to retire bonds before their maturity, we may have to record a partial period amortization of the discount or premium. That happens because if we're calling them at a time when it's not, we haven't accrued the interest, then we need to make a journal entry to accrue that interest. Okay. We're going to remove any unamortized discount or premium that relates to the bond, get rid of it, and we're going to debit the bond payable for the face every single time because only the face went into bonds payable. Okay. We'll credit a gain or we would debit a loss. So on like this entry right here, you could have figured out that 100,000, this one, and you could have backed into that number just because you knew the journal entry. If you need a credit, it's a gain. If you need a debit, it's a loss. Okay. And then credit cash for the amount paid to retire the bonds. Okay. We're almost done. So we're going to just kind of look at how these liabilities are reported. And you can see these bonds payable, you can see them right down there. That's the one we've been working with. And it's got the face in the bonds payable, then the discount gives it a book value 96,919. Okay, that's how they present it on the balance sheet. Sometimes they may actually do, like instead of another line, they may say bonds payable net. Okay, all right, that is all for chapter 14. I will see you in the next video.